$7 trillion. That's the bill hitting the US government this year. And the Fed, they have no clean way out. Now, let's be clear about this. We're not talking about some wild prediction or a theory. This is a number that's already locked into the calendar. That number, $7.1 trillion, that's how much US debt has to be rolled over. It's an absolutely staggering figure, and honestly, it sets the stage for pretty much everything we're seeing in the markets right now. So, understanding this number, that's the key. By the time we're done here, you're going to know exactly why the markets feel so completely irrational, why those crashes everyone keeps predicting never seem to happen, and, this is the big one, what it all actually means for your money. All right, let's talk about the deadline, because this isn't some far-off problem. The core issue is simple. A massive amount of US debt is coming due, and it has to be refinanced in a totally different and way more hostile interest rate environment. What you're seeing here is what people on Wall Street call the debt maturity wall. And again, this isn't a guess, it's a fixed schedule. Just look at how the amount of debt coming due shoots up this year, and then it hits this massive peak in 2025 and 2026. This is the kind of financial reality that, doesn't really make it into the campaign speeches. And this right here perfectly illustrates the trap. All of this debt we're talking about, it was originally issued when interest rates were basically zero. But now, it has to get rolled over at rates of 5% or even higher. That's a gigantic jump in the interest cost, creating a massive, massive headache for the US Treasury. So all this pressure, it leads directly to the Fed. And they're facing what is basically an impossible choice. They're caught in a financial trap where, honestly, there are no good options. Any conventional move they make could trigger a crisis. Which brings us to the crucial question. What can the Federal Reserve actually do about this? I mean, think about it. The market can't just absorb all this debt at these new higher rates. So the pressure? It falls squarely on the Fed. Okay, so publicly, they have two main options, and frankly, both are disastrous. Option one, let rates stay high. The risk? Failed Treasury auctions, maybe a full-blown financial accident. Option two, cut rates and cut them fast. Well, that would just reignite inflation and create a huge political firestorm. But they chose a third path, a hidden path, and this is where it gets dangerous. That hidden path? It's a silent liquidity injection. So here's the mechanic that nobody is really talking about. This isn't the headline-grabbing quantitative easing we all heard about years ago. No, this is something much, much quieter. Something happening completely behind the scenes. And this shows you exactly where the money is coming from. Think of the Fed's reverse repo facility like a temporary parking spot for cash for big financial institutions. As you can see, that account used to hold over $2.5 trillion. Now, it's been systematically drained, and that money didn't just vanish. It was pushed back into the financial system, specifically to help absorb all this new debt. This quiet injection adds up to about $135 billion flowing into the markets. Now, that's a significant amount of money. But it's happening without any of the big press conferences about rate cuts or QE. This allows the Fed to prop things up without, spooking everyone about inflation. So here's the bottom line on this. While everyone in the media is obsessing over when the Fed will cut rates, the real story, the thing that's actually happening, is this silent manipulation of the balance sheet. That's the huge disconnect between the headlines and what's really going on. And this leads to a realization that it resets everything. The markets aren't rallying because the economy is strong. That's not it. They're rallying because the Federal Reserve simply cannot and will not allow the US debt market to fail. What we're really witnessing then is a market on life support. The rising asset prices we see, that's not about genuine economic growth. It's a direct result of the system needing to survive this debt wave. And the data on this is just stunningly clear. There's about an 80% correlation between these liquidity flows and asset prices. When liquidity goes up, asset prices follow. It really is that simple. You can see it plain as day in the stock market. It's just been climbing on this wave of liquidity, often completely ignoring all the mixed signals from the actual economy. And it's the exact same force driving other assets, even highly sensitive ones like Bitcoin. It's the same mechanic, the same effect. Prices go up. In fact, when you just zoom out for a second, you realize this isn't about any one asset class. All assets are being lifted by the exact same underlying tide of engineered liquidity. Okay, so this brings us to a really important shift in how you should look at things. If you really want to understand this market, you have to stop watching the headlines about inflation and rate cuts. You need to start watching the liquidity flows. So what does all this mean for you right now? Well, here are the key takeaways. First, you have to understand that market crashes are being suppressed, not eliminated. The risk is still there, it's just being kicked down the road. Second, expect some pretty sharp spikes in volatility. Anytime these quiet liquidity injections even pause, the market could react badly. And third, remember this. Your cash is quietly losing its value, its purchasing power, as the system gets flooded with all this liquidity just to manage the debt. And that really brings us to the single most important sentence to understand all of this. This market isn't broken, it's being held together. But, and this is so critical, you have to understand this support system comes with a huge risk. It's called repricing risk. This isn't a permanent solution, it's a temporary patch. And when that support is eventually taken away, asset prices could readjust downwards, and it could happen very, very quickly and violently. This is the hidden architecture of the market today. Follow for more clear explanations of what's really going on in markets, the stuff Wall Street won't tell you.